Good morning from Tokyo. This is TOI Japan Market Radio, March 9, 2026. I'm your host, bringing you the daily briefing on Japanese markets for global investors tracking exposure in this region. Today we're seeing significant moves across equities, currency, and fixed income, so let's dive straight into the session.
Thanks for having me. Right, today has been quite turbulent for Japanese assets across the board. The Nikkei 225 closed down 5.2% at 52,728.719, while the TOPIX fell 3.818% to 3754.0. The Mothers Index dropped 3.313% to 2,393.0, and even the J-Right Index declined 2.117% to 1965.0. On the currency side, USD JPY moved up 0.639% to 158.541, so we're seeing yen weakness accompanying the equity sell-off. Meanwhile, gold in yen terms rose 0.6% to 19,295.0, and crude oil surged dramatically by 13.3% to 102.99, which is really the catalyst behind everything we're discussing today.
That oil move is extraordinary. Let's start there because it seems to be the trigger for this broad market reaction. We're seeing headlines that the sharp rally in crude oil has pressured Japanese stocks, bonds, and the currency simultaneously. What's the transmission mechanism here for investors to understand?
It's a classic negative supply shock for Japan's economy. Remember, Japan imports roughly 90% of its oil, so when crude prices jump this aggressively, it hits multiple channels at once. First, you have the direct impact on Japan's trade balance. The import bill expands significantly, which creates immediate pressure on the current account. Second, corporate profit margins come under threat, especially for energy-intensive sectors like utilities, chemicals, transportation, and manufacturing. Third, and this is crucial for the macro picture, higher oil prices reignite inflation concerns in an economy where the Bank of Japan has been very carefully managing its exit from ultra-loose monetary policy.
So for equity investors specifically, which sectors are most vulnerable in this environment?
The pain is fairly widespread, but you'll see the most acute pressure in a few areas. Energy-intensive industries face direct margin compression, that's your utilities, chemical manufacturers, and transport companies. Consumer-facing businesses also suffer because higher energy costs eventually translate into reduced discretionary spending. Even exporters, who you might think would benefit from yen weakness, face a more complicated picture because elevated energy costs can dampen global demand and raise their own input costs. The Nikkei dropping more than 4,200 points in a single session, as reported today, reflects this broad-based concern about earnings revisions and valuation pressure.
That 4,200-point decline is certainly getting attention globally. When we see that magnitude of move in the Nikkei, what does it signal about investor sentiment beyond just the immediate catalyst?
A drop of that size suggests we're dealing with more than just routine profit-taking. It points to either a major reassessment of earnings expectations, genuine concern about a structural shift in the macro environment, or contagion from global risk-off sentiment. In this case, it appears to be a combination. The oil shock is the immediate trigger, but it's landing in a context where global bond markets are also selling off sharply due to stagflation fears. That combination, rising inflation alongside growth concerns, is particularly toxic for equity valuations because it compresses multiples while threatening earnings. For Japanese equities, which have enjoyed a decent run over the past year, this represents a meaningful test of whether the rally can withstand external macro headwinds.
Staying with that stagflation theme, we're seeing reports of a global bond sell-off deepening as the oil jump stokes these fears. How does that global fixed income repricing affect Japanese government bonds and the Bank of Japan's positioning?
This is where it gets particularly interesting for Japan. Globally, bond yields are rising as investors reprice inflation expectations upward and demand higher term premiums. For Japan, this creates a policy dilemma. The Bank of Japan has been maintaining its yield curve control framework, targeting the 10-year JGB yield near 0%, But that's becoming increasingly difficult to defend when global yields are climbing. Today, even as Japanese equities sold off sharply, you'd normally expect flight to safety flows into JGBs, which would push yields lower. But the global repricing is working in the opposite direction, creating upward pressure on Japanese yields. The BOJ may soon face a choice between allowing yields to rise naturally, which would effectively tighten financial conditions, or defending the YCC ceiling, which risks losing credibility if global rate differentials widen too much.
And that has direct implications for the yen as well, correct?
Absolutely. We're seeing USD JPY at 158.541 today, up 0.639%, so the yen is weakening despite the risk-off environment, which is somewhat unusual. Normally, when you get a sharp equity sell-off like this, the yen benefits from safe haven flows and carry trade unwinding. But the stagflation dynamic complicates that. Higher oil prices directly worsen Japan's terms of trade. You're importing more expensive energy, which structurally weakens the yen. At the same time, if global bond yields are rising faster than Japanese yields because of the BOJ's policy constraints, that widens the carry differential and makes yen-funded trades more attractive. So you have conflicting forces, the safe haven bid versus structural trade balance deterioration and carry dynamics. Right now, the latter seem to be winning.
Looking at the immediate path forward, what are the key levels or catalysts that investors should be monitoring in Japanese markets?
Several things to watch closely. First, whether crude oil sustains these elevated levels or if we see some mean reversion, that will determine how persistent the margin pressure is on Japanese corporates. Second, any signals from the Bank of Japan about adjustments to yield curve control, even subtle changes in language around the 10-year target could move markets significantly. Third, upcoming earnings guidance from major exporters and energy-intensive companies. We need to see how management teams are adjusting their outlooks in response to higher input costs. On the technical side for equities, the Nikkei breaking below key support levels could trigger further momentum selling, so watch the price action closely over the next few sessions. And finally, keep an eye on global developments, particularly U.S. Treasury yields and any signs of stagflation concerns spreading to real economic data.
On the currency side, is there a level in USD JPY that would prompt intervention concerns from Japanese authorities?
We're at 158.541 now, which is certainly getting into territory where officials start expressing concern. Historically, the Ministry of Finance has shown willingness to intervene when moves are disorderly or when the yen weakens too rapidly. But with oil-driven import cost inflation, there's actually a case that some yen weakness helps exporters offset margin compression elsewhere. It's a delicate balance. I'd say if we push toward 160 or beyond with rapid momentum, verbal intervention becomes more likely. Actual currency market intervention is a higher bar and typically requires coordination or at least acknowledgement from G7 partners, but it's not off the table if yen weakness accelerates from here.
Shifting back to equities for a moment, the Mothers Index, which tracks growth and tech-oriented names, also fell 3.313% today. Are smaller cap and growth stocks facing different pressures than the broader market?
Yes, and it's worth distinguishing the dynamics. High growth, smaller cap names in the Mothers Index are typically more sensitive to discount rate changes. When global bond yields rise, as they are now, the present value of distant future cash flows gets hit harder, so growth stocks underperform. Additionally, these companies often have less pricing power and thinner margins, so they're more vulnerable to input cost inflation than established large caps. The 3.313% decline in the Mothers Index is actually somewhat less severe than the Nikkei's 5.2% drop, which might reflect that some of the worst-hit sectors today were large-cap energy-intensive industrials. But going forward, if stagflation fears persist and yields continue rising, growth stocks could underperform further.
We also saw the J-Right Index down 2.117% to 1965.0. What's driving real estate investment trusts lower in this environment?
REITs are caught between two forces. On one hand, rising JGB yields make the REIT dividend yields relatively less attractive, so you see some portfolio rotation out of yield-oriented assets. On the other hand, if inflation is picking up due to oil prices, real estate can sometimes act as an inflation hedge. But today's move suggests the former is dominating. Investors are repricing rights based on higher discount rates rather than focusing on inflation protection. Also, if stagflation concerns translate into weaker economic growth expectations, that threatens occupancy rates and rent growth for commercial real estate, which would justify multiple compression. So the 2.117% decline makes sense in the context of rising yields and growth concerns.
Bringing this all together for our global investor audience, what's the key takeaway from today's session?